Hello, and thanks for joining me to talk about stock and bond yields. I'm Colleen Anderson, financial advisor with the Capital Group based in Madison, Wisconsin. Today, I want to walk you through what's actually happening in the financial markets right now. Stocks are hitting new record highs, and at the same time, interest rates are sitting at their near highest level in decades. Now, I know what you might be thinking. How can stocks and interest rates both be doing well at the same time? Well, it sounds a little contradictory, but stick with me here because there's some really solid reasons why this can happen, and understanding it can actually help you think a little differently about investing in the long run. So here's what we're going to cover. First, what is actually driving stocks higher? Second, why trying to time the market and waiting for that perfect moment to invest can actually work against you. And third, why bond yields right now might be offering some of the best income opportunities we've seen in years. Let's get into it. So let's start with what's been pushing stock prices higher. If you look at the major stock indices, they've posted strong double-digit gains so far this year. A big part of that has been tech stocks. No surprise. A lot of that excitement has been around AI, which is really driving things. Energy stocks, though, have also had a really good run, mainly due to higher oil prices. But here's the thing. There's something more fundamental going on here underneath all of it, and that's the interest rates. Now, rates can rise for different reasons, and honestly, the reason matters a lot. If rates go up because people are getting nervous about inflation, that's usually bad news for both stocks and bonds. We saw this play out in 2022. But when rates rise because the economy is expected to grow more strongly, that's actually a different story. Stronger growth means companies can earn more and support those stock prices. At the same time, it means that better income for bond investors too. And that really does seem to be what's going on here. Now, when markets are sitting near record highs, a lot of people start wondering, should I just wait for prices to come down before I invest? And look, that's a totally normal feeling, but history actually shows us that this can work against you. Take a look at this chart. If an investor decided to wait for even just a 5% pullback before putting their money in, they would have waited an average of 291 days. That's almost 10 months. And here's the kicker. During that waiting period, the market would have already climbed nearly 14% on average. So why does this happen? Because markets generally tend to rise over time, which means that the next dip is often at a higher level than the last one. Now, to be clear, this does not mean that markets will always go up and that there won't be bumps along the way. There definitely will be bumps along the way. What it does mean is that hitting a new all-time high is actually just a normal part of a rising market. It's not necessarily some big red flag or warning sign on its own. Let's switch over to bonds for a minute. To take a step back, a bond is just a loan that you're making to a government or a company, and in return, they pay you regular interest. Now, while stocks have had a strong year, bonds have been relatively flat, and that's because interest rates have been rising. And here's why that matters. So bond prices and bond yields move in opposite directions. So when the interest rates go up, the value of the bonds that you already own goes down. This is the short-term pain point. But here's the flip side. Higher yields also mean that investors can now get much better income from the bonds that they've been able to hold up until this point. And that's really a higher yield that we've seen in almost the past 2 decades. Take a look at this chart. The yield at the time that you buy a bond is one of the strongest indicators of what kind of income you're going to earn from it over the long run. And right now, high quality corporate bonds and government bonds are offering income levels that frankly have just been hard to find for a long time. So if you're interested in investing with a long-term view, this actually presents some pretty meaningful opportunities in bonds. Opportunities that we just haven't been, seeing for quite a while. So that's it for today. I hope that you found this information helpful. And if you'd like to dig into any of these topics further, please don't hesitate to reach out. I'd love to hear from you. Thank you.